All right, well, welcome to the webinar. We have an interesting topic today, leveraging equity to get what you want in 2023. So I'm just going to quickly, this is going to be a really informal format. So feel free to unmute yourself or type in the chat if you want to contribute something. If you have any questions or anything like that, just feel free to jump in anytime. And I'm going to go through and see what we got here. So now I'm just going to fly through a few charts pretty quickly here. I wanted to share a little bit of information about kind of what's going on in the market, not just in housing, but in the overall economy in the US. Rates right now are up and they're likely to stay that way for a while. But to put that into a little bit of perspective, here is the 51-year history of mortgage rates in the United States. You can see this goes back to 1972. I just averaged it out for that entire time period, and the average 30-year fixed rate over the time that we've been measuring this is 7.76%. So current rate is 6.67%. So we're still below that. But rates are likely to stay up for a little while. The Fed is always responding to inflation. And so far, they're still in the mode of fighting inflation by hiking rates. They've already pretty much forecasted that next week they're going to hike another 0.25%. But then the Fed futures index, which is basically the stock market betting on what's going to happen with the Fed, is saying that we're going to see a series of pauses all the way through March of next year where they're not going to hike rates. They probably also won't be cutting rates depending on what happens, but at least pauses and no more rate hikes from the foreseeable future. Then starting in May of next year, we're expecting to see cuts, starting out with 25 basis point cuts and bringing the rate between 5 to 5.25 all the way down to 4.25 by January of 2025. Now, that doesn't mean mortgage rates will be at 4.25, but we should see them going lower sometime next year. That's our best guess. I mean, really, it's anybody's guess, but one thing to keep an eye on is that any kind of rebound in home prices might cause the Fed to get more aggressive with those rate hikes because they're going to be worried about recession fears. Now, they like to watch the CoreLogic Case-Shiller National Home Price Index, which is a median change on what the median home price has changed month over month. Now, you see increases there, but on this chart, you see the 0 is where the line is. 0.5 means a 0.5% increase. So that means the median sale price increased by 0.5% from June to July. That's not really something to be worried about. And when you look at the data another way, like the National Association of Realtors issues this average sales price of homes sold in the US, and they're showing that actually in the first quarter of 2023, we saw the first decline in home prices since COVID. And here in our local market in Yuma, it basically looks like this, where that decline in single family homes in Yuma went from 319 last year to 318 so far this year. So nothing really to worry about at this point. So, but housing isn't in its own little bubble. It's usually the biggest chunk of a family's monthly budget. So it's important to watch what else is happening in household financing trends. And this is the trend right now, is that personal savings rate is down. In fact, I saw one chart that said post-pandemic stock of excess savings expected to be depleted by September 2023. And then at the same time, credit card balances are going up almost at $1 trillion of credit card debt on personal credit cards. And when you look at that, the scary thing is that this time last year, the average rate on a credit card was about 14%, and right now it's 22%. So as credit card balances are rising, so are the interest rates, which means the monthly payments on those are going up, which is putting more of a squeeze on people's household budget. So the one bright spot is home equity. And according to Black Knight, the average equity that a U.S. homeowner has is $247,000. So if you have a home that you've owned for a few years, then most likely you have home equity, and equity equals options. So if you have a home and you have home equity and you want to do something with it, then the question is, what do you want to do? So we're going to run through several different scenarios, and I'll just share a few stories of recent clients and what's worked for them. And we're going to start off with an innovative bridge loan product that Nova just came out with that lets you buy your next home first and then sell the home that you want to move out of and leverage your equity without having to sell it first. So, but whether you want to move up or move down and downsize your home, or if you want to stay in your home but reduce your monthly bills or create cash flow by converting your home to a rental property, your home equity can be the key to making that happen. And so we're going to run through examples of each of those. Okay, so if you want to sell your house and make it non-contingent using a bridge loan, let me just show you the normal hurdles when you're selling a house and buying the next one is having enough money for your down payment and closing costs. So a lot of people, when they want to buy their next house, they're counting on the funds from the sale in order to cover their down payment. So if you have enough money in savings where you could make the down payment anyway without your house selling first, then this might not be an issue for you. The other issue is having enough income to qualify for both houses, which for most people is an issue. But again, if you have enough income, then that's not a hurdle for you either. But this bridge loan product allows us to get past that. So the normal process is super frustrating for somebody if they want to get into a new home. It starts out with this excitement. And I like this graphic of it being a roller coaster because that's really how it feels, of the ups and downs and the emotionalness of selling your house and buying the next one. But you start out being excited because you find a house that you want and it's your dream home. And then you realize that you can't buy it until your house sells. So you go through the frustration of either having to live through repairs and getting your house ready to sell, and then possibly even losing your dream home on the next one because the process drags on too long or the seller doesn't want to accept a contingent offer. You get angry because your house is on the market and you're still living in it, which makes it harder to sell. And so you end up getting lowball offers and just different hidden costs of repairs and things like that. And then as it gets closer to, even if it is going to work out, you have the anxiety of maybe having to pay 2 mortgages or potentially have to live in a rental short term while you wait for your old house to sell and move into it. So that ends up being a bad experience for everybody. For the realtor, it ends up being kind of a non-referable experience. The client hates that time of their life and they think back on it with a terrible feelings, and that's just not what we want. So the knock home swap bridge loan lets you buy now and sell later. So it simplifies that whole process. Basically, you buy the house and move into it first, and then you get your old home ready to sell. You put it on the market, you sell it, and then your home is sold later. So much simpler process, less emotional. What ends up happening is you get two loans. You get a new purchase mortgage, which will get the person qualified for a mortgage with Nova. And then this home swap bridge loan would be a second loan on your existing house. So a couple of the details of this. Now, it allows you to get up to $650,000, just depending on how much equity you have in the house. But you're allowed to get on the bridge loan up to 30% for your down payment plus closing costs that you need to close on the house. You're also allowed to add up to 6 months of monthly payments into the bridge loan so that you don't have a house payment on your old house. Just here. That way you don't get stuck making 2 payments because the payment's already built into the bridge loan. You're also allowed to add up to $35,000 of home prep. So if you need to do anything to get your house ready to sell, you can add up to $35,000 to the bridge loan in order to make those repairs. And then the last part is if you need to pay off any other debts in order to qualify for the home that you want, the bridge loan will allow you to add those costs into the new loan. So depending on equity, of course, you have to have enough equity to make all this happen. But if you have plenty of equity, you're allowed to do all of that. Now, the bottom line is you can make an offer non-contingent on the sale of your listing and get you into your dream home without all of the hassles that we talked about. So everybody wants to know what the costs are. So the closing costs are basically 2% for the bridge loan, 2% of your on the listing, up to $15,000. There's flat fees of $1,750 for closing costs on the bridge loan, and then there's 0 payments for up to 6 months. So there's you won't be making payments on the bridge loan, and it's 0% interest. They don't charge you interest on the bridge loan. It just, they get paid through the fees that they charge, that 2%. So Let me just walk you through a quick example here. But basically how the calculation works is you're going to take your combined loan amount. So here, if we just look at this over on the right, your departing property, say they're listing it for 500,000. You're going to get a guaranteed offer for 400,000 from NOC. That's just part of the bridge loan, is they're going to offer to buy your house for 400. You'll get a written offer. That's part of what allows us to qualify you without both house payments on the new purchase. Now, say this person owed 200,000, their monthly payment's 2,000. That means 6 months times 2,000 is 12 grand. Remember, it's going to be at 0% interest for 6 months. The contract fee would be 10,000 in this case. Bridge loan of 1,750. The agents get paid a normal commission. In this case, we're not paying off any debts or fixing up the house or anything like that. But down here, you see the maximum bridge loan amount is 175,500, which is based on basically 75% LTV of the expected sales price of the house, and then minus what you owe on it. And then the bridge funds towards the new home, if you notice this 151, that's how much cash you'd actually get in order to do your down payment and everything towards the house after they subtract the fees out. So there you go. It allows you to close faster. But basically, I like this as well, that what we do up front is we just have to verify that the listing, that the house you're selling is eligible for the program. And then you'll get your non-contingent pre-approval right away within a day or two. It takes usually about 24 hours to get a pre-approval on the old listing. And then basically you close on your new home purchase, and then that's when your 6 months at 0% starts after that. So you can sell your house. If it sells quicker, then the bridge loan goes away as soon as the house is sold and paid off. So any questions about any of that? The other question that comes up is, where can clients list? So these are the states where they're approved for the bridge loan. Now you can buy a house anywhere using this, but to sell the house, it has to be, these are the states that are eligible for that NOC bridge loan. So Washington, Oregon, California, Arizona, Colorado, and then a bunch on the east side. All right. So if you have any questions, feel free to reach out anytime. We can do these pre-qualifications pretty quick. I don't see any questions, so we will just keep on rolling on. Now, the next scenario I wanted to walk through is a move-up buyer, which is using their equity to pay off debt and afford a more comfortable home. So we had a client recently who, here's their old house. They paid $170 in 2019. They had a 4.625 rate. We've seen lower, but that still was pretty good. And their monthly payment's $1,239. They only owed $156,000, and the house was valued at $320. So they have a big chunk of equity in there. Her problem was the bedrooms were too small. She wanted something bigger. And so the house she found that she wanted was $450,000. And even if she sold her house and dumped all the money, she'd have about $135,000 of net proceeds. The new payment was going to be $2,512. So because the interest rates are higher, she's borrowing more money, $1,273 of payment shock. That really stopped her in her tracks. And she said, well, I don't need bigger bedrooms that badly. So she was going to move on, until we just looked at her whole financial situation and said, okay, let's see how we could potentially make this work. So what we noticed in her case is that she had a lot of other debt, a Mazda payment, a Razor credit card. So total of $53,000 of other debt, which totaled $1,345 a month. So when you add that to her mortgage, she was actually paying $2,584 already in debt payments between her house and all of her other payments. And so what we proposed was doing a debt consolidation purchase, where instead of dumping all the funds towards her new purchase, she used some of the money, $53,000, to pay off the other debts, take a little bit bigger mortgage on the new house. And now it was going to be $2,848 would be the new monthly payment. But remember what we're doing here. If you look at this over on the right, her existing bills, including all the installment and revolving loans, was $2,584. And now we were able to knock those out to zero. So the only payment she would have is her new house payment at $2,848. So you can look at that and say, okay, it still goes up. But now instead of $1,200 of payment shock, it's only $265. So now she gets the house that she wants, and her monthly budget only changed by $265. That's a lot easier pill to swallow. So the end result was, yeah, she ended up getting the house she wanted. Now, if you want to look at this, or you have a client who wants to look at this, we have a debt consolidation analysis. It's a little website that we create individually for each client where they can kind of play around with the numbers and look at it, and they get a little individual analysis. Sometimes it works out even better. In her case, it was still red at the end, but only by a couple $100, so pretty nice. There's some other options for keeping people's payments low. The 2-1 buy down is a great option in some cases. If your rates are close to 7% right now, in year 1 they're going to get a rate at 5%, and then it goes to 6% in year 2, and so that gives you a way of making it a little more affordable and getting you into the house quicker and easier, sooner, and kind of growing into your monthly payment. So moving on, some people want to keep their house. Now, if you want to keep your house and convert it to a rental, this is a tricky proposition right now. One thing that works in people's favor is having a nice low payment on their old house. So here's just an example. Let's say I think I'm using the same numbers from the last example. Her payment was $1,239, and that house would rent for $1,750. So that at first look, it gives you cash flow of $511. So that sounds pretty nice. But if you factor in having to pay property manager fees, which a lot of times, especially first-time landlords, will want to use a property manager to avoid all the headaches of their first renter until they get used to it. So that ends up net cash flowing $366. Now, if you want to rent out your house and then use that rental income to qualify for your next purchase, we can only use 75% of the rent. So that $1,750 goes down to $1,312, which still will help you a little bit. That still offsets your old payment, and you don't have to qualify with both. So that's an option. Now remember, when she was putting all of her equity down, the payment was going to be $2,512. But say you are going to keep your house as a rental and you want to keep your low payment, you probably will just put as a minimal amount down. So if she had bought that same house with only 5% down, the payment would be $3,223, which is a $711 increase in payment. Now, part of that's offset by the $511 cash flow. And also keep in mind that $257 of that payment is going towards principal. So that's it kind of works out. It doesn't cash flow completely. But if you have the means to put 5% down on your next purchase, keep your old house as a rental, you still are coming out ahead in this scenario. So, but it definitely is, with the higher rates, when you're buying a house at a higher price than your old one, then you will see some payment shock that's not quite offset by the rent in a lot of cases. So, all right. Anyway, if you have questions or want to run a scenario like that, then reach out. And let's go on to the next one, debt consolidation refi. So for people who want to keep their house and stay in it, I'll run you through a recent, this is a good example, I think, because we had this client and they were very happy with the results. So they had bought the house in July of 2015 for $140,000. Now in April of 2021, we actually refinanced it to a 20-year loan at 2.49%. So she felt stuck in this because she said 2.49, I can't give that up. Her payment's $849. She's 2 years into it at this point, so she only has 18 years left, and $849 is a nice low house payment. But she had a lot of other debts. When you add all this stuff together, all these different credit cards, you're coming up with $60,000 of other debt, $1,704 in monthly payments. Not only that, if you look at the blended interest rate, so we put in the mortgage here at 121 at 2.49. Okay, so, but are you really getting 2.49%? When you factor in all these other credit cards, her blended rate, which is the total cost of interest that she's paying on everything, is 8.259. So that's something a lot of people don't really realize, is that your mortgage at a super low rate, if you have a lot of equity, might actually be costing you more interest if you're avoiding giving up that rate and holding on to other debts at higher rates. So not only that, she said she felt like she was drowning in debt, and it wasn't so much that she couldn't make the payments, because she was keeping up on the payments. It wasn't a problem, but just keeping track of 10 different bills every single month was just a little too much for her. So here's what we proposed in her situation. She had plenty of equity. The house was worth over, it appraised for $305,500. So we basically increased her loan amount, got her a new loan, paid off everything else. So if you look at this proposed column over here on the right, her new monthly payment was $1,225, and she just had one monthly payment. It saved her $1,329 of monthly cash flow. Now, remember that she wasn't having a problem with the monthly cash flow. She was okay making the monthly payments. And so we put her on a plan to continue making that same monthly payment. But now what it means is just pay your mortgage, but pay $1,329 extra towards the principal every single month. And by doing that, she was on track. This plan came together to pay the whole thing off in 7 years and 11 months. So completely debt-free in less than 8 years without increasing her monthly payments by $1. She's making the exact same payments that she's already used to. So you might think that this kind of thing is bad because remember, we took her mortgage from 2.5 to 5.75. We increased her mortgage payment from $850 to $1,250, and we stretched out her mortgage from 18 years to a new 30-year term. Not only that, we added unsecured debts, credit cards to her mortgage. So we're actually putting her house on the line for credit card debt, which can definitely be a bad thing. But her review at the end of this was life-changing. And I remember, I remember reading that and just feeling so happy that basically, if you look at her actual life and how it changed her life, it took the monthly bills that she had to pay from juggling 10 different bills down to just one monthly payment. Her blended interest rate that she was paying on all debts went from 8.25 down to 5.75. And she's on track to be debt-free 10 years sooner. Because remember, she had 18 years left on her loan. And now by making the same exact payment, zero extra money out of her pocket, she'll be completely debt-free in 8 years instead of 18. So I think that's pretty awesome. Now, she could also get in trouble by not making the extra principal payment and charge those cards back up. That wouldn't be good. But if she follows this plan, then she's on track to be in a very good financial position. So again, we have this tool that we could do this for a refi or a purchase, where they'll get a personalized website. They could play around with the bills, decide what to pay off and not pay off. And it's pretty cool. So does anybody have any questions or anything? I don't see anything in the chat. We'll just keep powering through then. So downsizing is another thing that people are thinking about. So something to consider, and I'll share a story with you right now about a client who just downsized, and her new monthly payment's actually higher than the old house that was bigger. So why would you do that? You have to consider all the costs of ownership, not just payment. So a lot of times when people are downsizing, they're downsizing for lifestyle considerations. Like you're getting older, you don't want the extra bedrooms, you don't want the yard work, the pool, AC bills, all this stuff you have to consider. So one option to think about is a reverse mortgage if you're 62 and older, which I'll walk you through one of those in a minute. But let me just show you the example. And I didn't know how to make this any more visually appealing, but let me just show you. This recent client's old house, she owed $181,000 on it. Her rate was 2.875. We refinanced her a few years back, and the monthly payment's only $1,040. Now her new one, if you look at the new condo that she bought, she got a loan amount of $156, 5.5 rate, which is a pretty good rate, but it was it's on a 7-year adjustable loan, and her new monthly payment's $1,246. The $1,246 includes her HOA fee of $225. So that's something to consider. But still, she used to be paying $1,040, and now she's paying $1,246 after downsizing. So who would do that? Now she looked at all of her other bills: yard guy, pool service, trash and water. Her APS bill was higher because it was a bigger square footage house. So the total cost of owning that home was $1,765 a month. And then when you look at the condo, well, the yard, pool, trash and water was all included in the HOA fee, and her APS bill is estimated. Hopefully this works out, but it was estimated to be $100 lower than what she was paying. So her real cost of living there is about $300 a month less expensive. Not to mention that now she doesn't have to worry about all that other stuff that she doesn't want to. So something to think about. Okay. Now, reverse mortgage is another thing to consider. Now, you have to be, I don't know why these are going out of order. You have to be 62 and older, but it allows you to access your home equity as a tax-free loan with no monthly payments. And you can do this to purchase a primary residence or refinance. So if somebody has a lot of equity in their home and they want to downsize to another home, you could sell your home and take the proceeds and use it to purchase another home using a reverse mortgage and never have a monthly payment on it. So what the reverse mortgage would do is allow you to basically double your purchasing power. So if you want to downsize, but the house you want is more than the cash that you have available to pay cash on the home, then you could still buy it, take out a reverse mortgage for the rest of it, and still never have a monthly payment the entire time you live in a house. So we'll do another webinar and probably a little video series on reverse mortgages, but it's a really cool option for the right buyer. So the bottom line basically is that if you have equity, you have options. So please feel free to reach out. We're here to help. My team, Paula Boyson, Joe Figueroa, we're all here and available to help out and analyze the options, because everybody's situation is unique. There's different things that you can do. And so it really is worth at least having a chat over the phone, and then we can put some of these tools to use for your situation and figure out what's the best thing for you to do. So feel free to reach out anytime. If there's no questions, that's all I have for today. So we'll go ahead and end. Any questions from anybody? Okay. Well, thanks for coming, and take care.